Chapter 3. Adjusting and Closing Entries. Adjusting and closing entries are what makes month-end, quarter-end, and year-end go around. Accountants will often say, "We need to close by," and then they will say a day or date. If you've ever wondered what they're talking about, here in Chapter 3 is where you will learn what they mean. What they are talking about is closing the books, not shutting the business down, but doing the journal entries necessary to comply with the matching principle. For instance, a business needs to journalize the amount of revenues they earned and expenses they incurred last month, last quarter, last year, and also present the proper balances of their prepaid assets and deferred liabilities on the balance sheet. Here's an item to keep in mind during this chapter that many students gloss over, but it's a simple rule. All adjusting journal entries include one balance sheet account and one income statement account. If your adjusting journal entry looks like this, a debit to prepaid rent and a credit to unearned revenue, both balance sheet accounts, the adjusting journal entry is wrong, because the rule is all adjusting journal entries include one balance sheet account and one income statement account. So in order to properly adjust those balances for the prepaid asset and deferred liability, what you would need to do is to debit rent expense, which is an income statement account, and credit prepaid rent, which is a balance sheet account related to the income statement account rent expense. Or you could debit unearned revenue, which is a balance sheet account, and credit earned revenue, which is an income statement account. Keep this rule in mind as you go through Chapter 3 and making the journal entries. So long as you stick to one balance sheet account and one income statement account, you shouldn't have any problems. Okay? Have fun.